Justin, hi. So in the sort of latest video of our series, we're going to be talking today about EBITDA, that mysterious acronym, and EBITDA multiples. Very important topic, very interesting topic. We're going to touch on concepts of adjusted EBITDA as well, perhaps talk about some multiples which are typical in different sectors. Do you want to open up? EBITDA is very important from your corporate finance perspective.
It is. So EBITDA is, so the acronym itself, I mean, it effectively relates to operating profit.
Okay.
But of course it means something in terms of a mathematical or financial terms. So it's earnings before interest, tax, depreciation, amortization and depreciation. So typically if you look at your statutory accounts that are produced by your accountant, you will see an operating profit number in those accounts. Typically what you have to do is you have to mathematically adjust that number to get EBITDA, and inevitably you're adding back depreciation, which might be carried in your sales general administration, your overhead number in the accounts, and you're deriving effectively your operating profit before depreciation, before you're paying interest, before you're paying amortization and so on.
Okay.
It's a really important number because actually the roots of it are, it shows a potential investor or buyer the ordinary cash flows. It's not a direct correlation because actually is that it shows how much cash the business generates before it invests in things like capital expenditure, investing in other activities. So it's kind of like it's an important peg in the ground, as it were, because a buyer can say, well, if the business generates £1 million worth of EBITDAs, it says, well, roughly speaking, is on a steady state basis, the business will generate £1 million worth of free cash flows over a very long period of time before the business invests in things like fixtures, fittings, and investment in capital expenditure and so on. The reason it's so important is because it forms the basis of most valuations of companies.
Yes.
There's various ways to calculate or estimate the value of a business. There's discounted cash flow analyses, there's net book value analyses, there are all sorts of revenue multiples that you can look at, but actually as an industry, in terms of the pragmatic, practical realities of life, most buyers value companies based on the EBITDA value of the business, the sustainable operating profits before depreciation and so on, multiplied by an industry norm, a number. So
And
EBITDA.
Are businesses typically in their, say, monthly management accounts, monthly financial reporting, are businesses typically reporting on and tracking EBITDA? Is that something in your experience SMEs tend to do?
It's a good question, and the answer is no. I think it's just a black and white version of the answer. So no, I mean, typically an SME will be looking at sort of operating profit. Very few look at the sophistication of EBITDA. So right from the off, that's an unfamiliar term.
It's a concept the seller's got to get to grips with, get an understanding of, you know, right at the beginning of the process.
Oh, that's absolutely right. And I think then we can sort of, before we get to the EBITDA multiple, as it were, you know, when you're selling a company, is a buyer is going to be looking at that business to say, what is the sustainable EBITDA from that business under my ownership and not yours?
Yes.
So
that's where we're getting into adjusted EBITDA. So in a scenario where a business is particularly cash generative, for whatever reason, the owners, the executive team might be extracting some of that cash by inflated salaries for whatever reason. Doesn't sound very tax efficient, but for whatever reason they might be doing that. But a buyer might be saying, well, actually, I'll be putting in a replacement management team who will be paid at a market rate. Therefore, we won't be extracting so much of the cash by way of inflated salaries. So then you get into your adjustments of what does that mean for the EBITDA calculation. Is that a sort of fair assumption?
I think that's a very fair assumption. I mean, typically my experience is most owners of SMEs will have some degree of costs, proportionate or disproportionate. It's their business, they can do as they like, that go into that business, and of course those costs won't be there. But equally, in today's, I suppose, tax regime, it is very atypical that sellers, particularly if they are shareholder operators, they're involved in the business, they're perhaps running the business, they typically take their compensation by way of a small salary, and usually the rest by dividends. I mean, of course, the tax regimes will inevitably change, but right now that's a very typical profile for an owner of an SME. The disadvantage with something like that is very clear, is in a seller's mind, a business makes a certain profit. And of course, they'll be looking at operating profit, not EBITDA. Typically, that operating profit is stated before the changes in the balance sheet due to dividends. In other words, they're not looking at the balance sheet, they're just looking at the operating profit level. And they'll assume they'll have done their mental calculations, spoke to their mates down the pub, and said, my business is worth operating profit times X, whatever the number happens to be, that's what my business is worth. But of course, we have to adjust that number to show what it looks like under new ownership. And if a new owner has got to substitute you and saying, well, you're running the business, we need a new managing director, it has to backwards adjust in the real cost of that. So of course is that it can change that operating profit or EBITDA number positively or negatively.
I suppose another example, and we see this sometimes, is property costs. Sometimes an owner of an SME might own the underlying property from which the business is operated. It might be held in a pension fund, it might be held personally. It's not always the company that owns the underlying property asset. For whatever reason, the rent might not be a market rent, it might be higher, it might be lower, it might be designed to be whatever suits the seller or suits the business. Any incoming buyer is going to want a arm's length market rent to be charged. That's something which again is going to have a swing on your adjusted EBITDA presumably.
I think that's exactly right, and I think the key to the key messages is one can never pull the wool over a sophisticated buyer. And of course, we both deal with buyers that are usually quite large in one form or another. And they will examine this and they'll come to the same conclusion. So, one is a seller saying, listen, the operating profit is X. Yeah, we don't pay the rent because we own the building. We don't pay ourselves a market rate salary because we pay dividends. But that's the number. It doesn't wash. And that's why a professional M&A firm, corporate finance firm will advise, I'm sure we amongst others would say, you have to present it objectively as a buyer would see it. One can show synergy, one can show the potential benefits of a business under new ownership, and I think that's a right and reasonable thing to do, because of course, there could be an improvement in that EBITDA, under new ownership.
Economies of scale on purchase, supply, whatever, you can try and factor those.
And we do that, we model those numbers. But that I hopefully explains the adjusted EBITDA number and saying, well, that forms one part of the equation of saying, what's my business worth? And then we move nicely over to the multiple.
Yes, which people always want to know what multiples are applicable to my business.
Yes, well, I think there's a very famous author that came to the conclusion that the reason of life was 42, wasn't it? I think it was Douglas Adams. It's the meaning of life, not the reason of life.
That would be a nice multiple.
And it's the same multiple that when you read accounting textbooks, typically you'll see the magic number of 4 or 5 as being, the average multiple for. And like all myths, there is a degree of truth. And the way that I like to try and explain this is to saying there is a bell curve, and most people are familiar with a bell curve. And of course, at one side, we've got a low multiple number. And at the top point, we've got an average. And then out here, we've got a very high multiple. And the reality is, it's different per industry.
Per sector,
yeah. I mean, it's common sense in my view. If somebody's going to buy a business and it delivers a certain cash flow, EBITDA, adjusted EBITDA, a buyer might say, listen, in a certain industry, I'm prepared to pay 5 times that value, 5 years worth of that number to buy that business. And it could be that in another type of industry, they could say, listen, you're in you're just about to discover the cure for cancer. Yeah? And that drug you're producing, that pharmaceutical compounds, might have a lifetime of 20 years under its IP ownership, and therefore I'm prepared to pay 30 times that EBITDA. So in other words, is that different industries command in the market, in real life, different EBITDA multiples. So it's, one can obtain, there's various organizations such as Experian, people like Deal Suite, people like Bureau van Dijk. There are organizations that track
deal data.
And I have to say, one has to treat that with a degree of caution.
Yes.
Because of course, is that typically they're only tracking deal multiples that are either A, reported, or B, driven by PLCs. acquiring smaller companies because they have to report those numbers. Private to private, limited company to limited company transactions typically remain unreported.
Yeah. And I suppose that, just to give some examples, businesses which are more easily scalable, those businesses, I'm thinking of IT, technology, telecoms, perhaps where you've got a certain piece of technology or an app, which means that your business can be rolled out nationally, can be rolled out potentially internationally fairly easily based on that technology. That would be an example where a buyer could hopefully be persuaded to use a higher multiple than, say, a more conventional business which has more traditional routes to growth and which might be a sort of slower and steadier path where a lower multiple might be appropriate.
I think that's rightly said. I mean, there are some ingredients, and perhaps want to touch on in another video, to say, well, how can you, if you know that you want an exit and you know you've got time on your hands, years, what can you do with your business to make that multiple a higher number? Then building in intellectual property, building in scalability. These are typically things that drive up multiples. But the other thing that, is what I call good old-fashioned competition. Because if you're selling a company, there's two different types of buyer who can buy it. In short, there's a strategic buyer, trade buyer, somebody in your industry, a bigger company. And another is a financial buyer, somebody that's going to buy that organisation simply for the financial profits your business make. Could be private equity, high net worth, family office, or so on. Typically, in terms of most of the SMEs we're dealing with, I would argue that a trade buyer, a strategic buyer, tends to be where the higher multiples come from. And of course, the key in selling a company is to create some competition. Absolutely. And just the element of competition itself between rival bidders that want to acquire the business, especially if it's well prepared and well presented, can drive the multiple up. But there's no doubt is that certain industries command certain typical norms in terms of multiples. Yeah. So you can have as low as 3 and you can have 20 plus. It depends what industry you're in.
Fascinating. Thanks, Justin.
Thanks, Nick.
Talk again.